Hello everyone, thanks so much for joining. I did another video on how a typical finance organization looks for a non-financial company, like regular retail, pharma, manufacturing, production, service company looks like. In this video I show you what is different, what is similar when looking at a finance department of a financial organization such as a bank. There are a few similarities but also a few differences. So in general, if we look at head of finance, CFO across a bank, and again, sometimes depending on the size, some of those sub-departments you see here can have an own chief risk manager and so on. But in general, those departments exist. You see a few more here. So if we go through maybe department by department, we would expect the financial planning and analysis department to be there as well. The tasks and responsibilities are slightly different because we're talking about a bank. Accounting, same, to ensure accuracy of financial records and preparing with accounting standards. Treasury department, still similar but different focus. Taxation department is actually quite similar, just that you deal with different products. And then what we have a few additional departments. Maybe we start with those. So we would see an additional risk management department, which identifies, assesses, and mitigates financial risks. It usually monitors credit risk, market risk, operational risk, and it ensures compliance with regulatory capital risk management frameworks. It does stress testing for adverse market conditions. It assesses the creditworthiness of borrowers or counterparties, monitors value at risk metrics for trading portfolios, and then it would also conduct scenario analysis and prepare risk exposure reports for regulators. Yeah, so a few different tasks. Then another one would be the regulatory reporting and compliance department. That is really, if you think about, every organization has to comply to accounting regulations and tax regulations. That's why we have an accounting department and a tax department. But financial products, insurance products, they have additional regulatory requirements. That's why there's usually a regulatory reporting and compliance department that ensures the adherence to those regulations beyond accounting and taxation. So this department would prepare regulatory filings, for example, capital adequacy reports, liquidity coverage ratios reports. It would ensure the compliance with local and international regulations, for example, Basel, IFRS, and solvency regulations. It would liaise with regulatory bodies like central banks, security commissions, or prudential regulators. Some of the key tasks would be monitoring changes in financial regulations and updating internal processes, and then as well submitting reports to those regulators on capital adequacy, liquidity, and leverage to regulatory bodies. It would also be responsible for conducting internal compliance audits. Another new department that we often see in financial organizations is so-called Asset and Liability Management, ALM, which is responsible for balancing assets and liabilities to optimize profitability and risk. It would manage the interest rate risk and duration gaps. It would align, when we look at a bank, for example, the bank's assets, which are the loans, with the liabilities, which are the deposits. It would maintain sufficient liquidity buffers. It would conduct gap analysis to manage interest rate sensitivities, managing funding needs through short-term and long-term debt instruments. It would do this in coordination with the Treasury department. And then it would also monitor regulatory liquidity ratios such as the net stable funding ratio, NSFR. If we talk about a trading and investment business, then usually we have a type of product control department that really looks at those financial products and trading activities and oversees the valuation and reporting of those. So it would ensure the accuracy of profit and loss from trading activities. It would value those financial instruments, including derivatives and structured products. It would monitor the performance of portfolios and trading desks. And then basically it would reconcile trading data with accounting systems and monitor pricing models for complex financial instruments. Investor relations, it's similar to a non-financial organization, basically communicating with shareholders, analysts, and investors. Let me just go back to the first ones, FP&A, in case you have not watched the other videos. Again, strategic decision making by analysis and forecasting, financial performance. Similar to non-financial organization, prepares budgets and forecasts for the organization's operations, and here especially investment portfolios. It would analyze the profitability of different financial products or business units, loans, investments, insurance policies, identifying trend and so on. It would also analyze key financial metrics. For sure, the financial metrics may be a bit different here. For example, return on equity would potentially be similar, but then net interest margin and so on. And then similar, it would prepare financial presentations for management and certain regulators. If there are specific regulators, then the department would work together with our regulatory reporting and compliance function as well. Financial accounting, quite similar. Adherence to IFRS and local general accepted accounting principles, handling audits and managing tax reporting for financial organizations, calculating fair value adjustments for financial instruments, reconciling subledgers with the general ledger for complex transactions. Good. Treasury, quite similar. Taxation, quite similar. If you go through, I show it here, if you go through in detail, please have a look. There are a few overlaps. For example, if you look at risk management, here risk management said responsibility is responsible for financial risks. And we also mentioned that Treasury is responsible for managing financial risk. However, slightly different. If you look at Treasury, it's really the day-to-day management of financial risk, particularly related to liquidity, funding, and market conditions. Whereas when you look at the risk management's role in managing financial risk, this is more oversight, management, and strategic management of all risks across the organization, including credit, market, and operational risk. So slight differences. Also, another one is we said risk management does scenario analysis and preparing risk exposure reports for regulators, and we said regulatory and reporting and compliance does the same. Again, risk management here, strategic oversight. Focus is on understanding, measuring, and managing risks to ensure the organization's resilience. If we look at regulatory reporting and compliance, they are responsible for the operational reporting and documentation required by regulators, and to ensure these are accurate, timely, and compliant with all laws and regulations. So it really depends on Where you look from, there are slight nuances, but in general, yeah. All of those departments should not work in isolation. They should work collaboratively together. But I hope this overview gives you an intro, a better understanding how the typical structure of a finance department for a bank, insurance company, or investment company could look like. Thank you so much for listening. See you in another video. Bye bye.